Hi everyone, now we are into the third session in the FinTech domain in the course Introduction to Commercial Banking and FinTech, and we are analyzing the FinTech segment. We discussed most of the sections, but what comes out in the final learning is that the data becomes the key in decision making, and how FinTech is implementing big with the data applications, and how the FinTech supplementation is much stronger in the traditional banking domain because it has the wider range of data sources and information precision. It also helps in increasing the screening and monitoring, and it also helps in faster automated underwriting decisions. So these are so more data, better risk prediction that we discussed in the last session. And in terms of alternative data, we have the UPI credit card transactions, bank statement cash flows, GST invoices, and utility payment behavior, and e-commerce sales and returns. So this is what here we have. Thin file borrowers, which means that suppose there are 1 million thin file applicants. So bank rejection rate is 60%, FinTech rejection rate is 40%. So additional approval that we are getting is 200,000. If the average loan size is 30,000, the additional credit that we are going to get is 600 crore, and this is what it matters. So better data expands the inclusion without necessarily the rising risk, and this is where it is important. Now credit risk model with data is nothing but here we can get into the so in terms of PD estimation, because the role of data is mostly with regard to improvement in PD. So here probability default is nothing but here we have data, then here income and the payment history. And when we are incorporating the FinTech, then we are seeing that it is having the traditional data plus alternative, and we saw that we are seeing an improvement in the probability default and especially the identification of good borrowers. So the good borrower has the incentive because the alternative data is giving FinTech that opportunity to calculate lower probability default. As a result, it will also have the lower rate of interest on the loan, and there will be more approvals at the unchanged risk target. So this is also one domain that we touch upon. So overall, what is the rich data, the work that the rich data is doing? Basically, rich data is improving the probability default, and it is adding value to the PD estimation. So this is where it is important. So suppose exposure at default is 500,000, the probability default is 6%, and loss given default is 50%. So expected loss is 0.06 into 0.50, and here we have the 500,000. So overall the expected loss is going to be 15,000. So how this 15,000, so it will be passed on the pricing and the provisioning implications, and this is what it helps. Now if I have to calculate in terms of break even interest rate, so we can get into, suppose funding cost is like 7% of exposure at default. The operations cost is suppose 1% of the exposure at default, and expected loss is 15,000. So for exposure of default, which is 500,000, so funding cost is 35,000. This is what we are getting, 7% of the EAD. Operation cost is 5,000, 1%. So 7% of the and this is here you have the 1% of the 500,000. So break even requirement is how much? Break even requirement is 55,000. So your R rate of interest is how much? It is going to be 11%, which means that it will be hovering around 13 to 15% given this. So risk based pricing may play important role because here we are considering both the exposure at default, operation cost, and also the expected loss that here we are having. So which means that the overall scenario looks like the range of the pricing will be between 13 to 15%. Now here we have the scale effect, compliance and privacy cost. Suppose the annual compliance cost per customer for a bank is nothing but here we have the 60 so asset management liability that we have. So here we have the rupees 60, so verification and monitoring reporting cost, and it also checks the audit requirement. For 20 million customers, the cost is going to be rupees 120 crore per year, right? So large scale of the monitoring if you are doing, then it creates the trouble, right? So, and if we are going for the fintech, so with the application of data, the fintech may be having the lesser cost, and this will further cut down the cost for the conventional commercial banking, and this is what it says. So, very large platforms, if you have like, for example, if you are going for a very, if the particular fintech platform is expanding, so this also becomes a challenge as compared to conventional bank. Conventional banking may not be having that kind of systemic risk because it is already well regulated, but fintechs are more challenging because the regulations are a bit relaxed, and if the volume is increasing, then as a result the cost will also go up, and this will create trouble. But in case of fintech, the cost as compared to commercial banking, as we have seen, it is much lesser, and they work on almost like a fraction, right? So this is where it is very, very important. Now, what has been the global trend in terms of fintech? So one has been with respect to technology. So there has been a lot of deployment of technology from different forces. One is the smartphones, cloud computing, APIs, AI based analytics. Economics, like for example, low marginal cost, scale economies, platform effects that we can always see. Institutions, which all institutions? So digital IDs, fast payment rails, open banking frameworks, it all plays important role. Then underserved users also create the good scenario, and financial inclusion and convenience preferences play important role. So for example, you can see here smartphones plus digital channels, cost saving. So digital delivery replaces branch heavy servicing models. For example, servicing cost per branch is, suppose it is 40, and digital it is just ₹8. So monthly saving for the bank for the 10 million customers, it is certainly is going to be 32 crore, and annual saving, if you think in terms of annual saving, so here it is going to be around 384 crore, right? So 32 into 12, so it is coming out to be 384, which means that digital channels help reduce the cost, and commercial banks can utilize the benefit. So in India, majority of the commercial banks are using this benefit, and they are also earning good amount of money in this. So second is cloud and economies of scale. Suppose fixed technology cost is rupees 200 crore per year, so you have to maintain the server, and you have to now manage the whole the data center, and you require a lot of people, and they are also, you have extra cost of it. If you go by cloud, which means that you give to third party an annual payment, then so fixed cost technology cost is rupees 200 crore per year. The variable cost is rupees 10. So you can think about the average cost. The average cost is 200 crore upon the n number of users. Suppose number of users are 2 million, so it is coming out to be, average cost is coming out to be 1010. If there are 20 million, so then it comes down to 110, which means that the cost advantage for the large platforms is much easier, and this is also one of the reasons that why there is a lot of market concentration that we discuss in the Herfindahl-Hirschman index, which is the common. In terms of data, so World Bank is having the World Bank Global Findex 2021. This data set is available on the World Bank. It is open source. You can download and see which all variables they are considering for measuring the fintech activities, and this also gives a lot of advantage. So adults making receiving digital payments in developing countries, so 35% you had in 2014, now it has reached up to 57%. And account ownership has also gone from 76% among adults, right? So it creates a lot of data for the fintech to analyze, and these digital transactions are helping in terms of right decision making, calculation of appropriate probability default, right? So payment often become the entry point and broader fintech ecosystem. So this is how it matters a lot. The KPMG in its report Pulse of FinTech, they mentioned that global fintech investment in 2024, it was $95.6 billion, and payments related sectors investment, it was $31 billion, and venture capital investment was really high. So which means that overall the scenario looks better, and it creates the scenario even in favorable. Global leaders are USA because of the deep venture capital markets, innovation hubs, and a strong capital market fintech, because this is one area we'll be discussing about innovation hubs and when we go into the fintech regulation, and there we'll be talking about, and a strong capital market fintech is also one domain. China, here we have the super app ecosystems and large platform adoption, that also matter. The digital public infrastructure like UPI, Aadhaar and account aggregator, right? So this is how we have. So common success is what? Digital infrastructure plus scale plus regulatory innovation play a very, very important role. Now, in India, we have the digital payment infrastructure DPI stack. Under that, here we have the Aadhaar enabled eKYC. So nowadays, a lot of platforms are going for eKYC for onboarding and also the verification. Real time payment. So UPI has given unified payment interface has given a lot of advantage in quick transfer of money and quick payment. But the challenge is that the larger volume transactions are not happening. Only the micro payments are done through UPI. So this has been one of the challenges for the governments because they are not able to tap the larger amount transactions through UPI. And of course, once we have the digital interface, then it reduces the cost in a significant way. Data sharing layers, which means that on one platform you can get all types of services, like for example, you have Policy Bazaar and others. So account aggregators are also playing, and account aggregator framework is helping in the financial data access, and it is also helping the fintech to expand the horizon of services, and this is where it is helping. But of course, cyber and other related are still concerned. So suppose onboarding time falls from 3 days to 10 minutes. For example, if you go through eKYC using digital identity eKYC, so assume the daily wage volume of time, it is rupees 500. So the amount of time that you are saving, it is humongous, right? And it is going to play important role. And this is where it creates a good sense and good impact on the scenario, right? So if you have a onboarding for 10 million users, aggregate time saving imply large consumer surplus gain. And second thing is the confidence, that if you have instant verification done, then it brings a lot of confidence to the customer, and they will be happy to utilize a lot of services which they may not be initially interested, but since it is quick process, identification, verification is done quickly, then it becomes easier for them to handle, right? And this is where it becomes easy. Now, there are studies talking about fintech as a competitor to the commercial banking. Now, there are a for and against argument. Argument is that it is forcing the banks to adopt new technologies, utilize the services, utilize the data into a right decision making in terms of probability default calculation, giving the lower rate to the good borrower or nice or safe borrower as compared to having the pooled rate of interest. So this is also helping. Second thing is that the second dimension, against dimension, is that fintech in a way it is becoming competitive, and a lot of intermediation work done by the conventional banks are losing because of the fintech rise. So here, for example, fintech competes with traditional banks primarily in payments and settlement services. This is one area. Consumer and SME lending, so this is also one area, and wealth management and low cost advisory is another. So here we have the underlying economic forces. So lower entry barriers versus digital platforms is this. Reduced saving cost for customers are this, and data driven models like weakening traditional bank market power and all those factors play important role. So lower entry barriers, which means that it is having through the digital platform. Reduce switching cost for customer, that it doesn't matter whether you want to avail this particular service or you want to go to another. Earlier you had to walk 10 times to the branch to request them to please close the account. Now it is easier. On the fingerprint you can easily see and find out that how much you have. So for example, bank earns rupees 2 per NIFT transaction, right? Fees plus float volume, and volume is around 200 million transactions per year. So revenue is around 40 crore. The instant payment systems and the fintech platform push transaction fee towards near zero, which means that the bank which was earlier earning because of the NEFT transfer 40 crore, now it is becoming zero because of the instant payment. So it means that the 40 crore is the loss for the bank. But here comes the role of regulatory body. If the regulator is also imposing the similar kind of transaction on the fintech and the bank, then it doesn't matter whether you are doing with the bank or the fintech. In India, a lot of activities of the fintech is taken care by the banks, and banks are already providing those services. For example, UPI payments are already aligned with the bank, commercial banking has also adopted, but competition in terms of cost, because commercial banks were earning for these transactions, but now they are because of the fintech having zero cost. So this plays a very important role. So cross selling the financial products, premium or subscription services. So this is one area. Greater reliance on lending margin is also one area that they are doing. Now competition in lending, and this is where it comes, the calculation of probability default, that why it becomes so important. So investors fund borrowers through a digital platforms, right? Credit scoring relies on alternative data, and this is where it is very important. Automated approval also has a role in underwriting. So for example, bank underwriting cost is suppose 1200, the fintech and underwriting cost is just 250, which means that lower processing cost enables the small ticket lending, and this is where it plays important role. Why banks and fintech partners? So fintech does not always displace banks, so collaboration is common. And a typical partnership structure is fintech. Here we have the onboarding, analytics, and customer interface is this. The balance sheet, funding, and regulatory compliance are this. So this is for the fintech, this is for the banks, and this is for the co-branded products and co-lending arrangements. So overall, the ecosystem is having both scale and trust, which means that fintech in a big way helping a lot the commercial banking. For example, earlier they were going by the balance sheet, funding, and the regulatory compliance. Now they can also onboard, go for instant eKYC and do it, right? And they can also go for co-branded products, right? Like for example, if you are having like a particular trading platform aligned with the bank, then they can offer a better trading services, and co-lending arrangements that they can also do it. So it also depends upon what has been the trust between a scale and the banking system that matters. So a co-lending model, let's focus on how it can work. So bank and fintech jointly fund a loan. So bank funds 80%, fintech funds 20%, so earns or an origination fee. So for a rupees 100,000 loan, the bank loan is 80,000, right? Because bank funds 80,000. Fintech funds 20%, right? So it is 20,000. If the borrower interest rate is 12%, the total interest is just 12,000. So this is what here we can see. So revenue sharing can be done, because out of 100,000, so 80% is coming by the bank. So 80% share is the bank. 20% is coming through the fintech, which means that whatever earning that they are making, if suppose 12% is the rate of interest, so 12,000 that they are making. So it means that revenue sharing follows the contractual waterfall. Fintech adds origination analytics, and a bank provides the funding and compliance, which means that out of this 12,000, they can go by the same criteria, that 80% of revenue will go to the bank and rest 20% will go to the fintech. So this is also one dimension we can look at. Another is the unit economics of the digital lending, which is like, so let's think about the loan portfolio. Suppose number of loans are 10,000, okay, average loan size is 50,000. So total exposure at default, it is certainly the 50 crore, right? So this is what we employ. Now if suppose we are assuming that the lending interest rate is 18%, the funding cost is 9%, probability default is 7%, and loss given default is 60%, and operational cost is just 2% of the portfolio. How the interest income exceeds the funding cost, and it has the impact on the expected credit and operational losses. So this implies like this. So exposure at default is rupees 50 crore, and income and cost components are like interest income is 0.18 of the 50, right? So this is what we are getting. Here we have the 18% in the lending rate. So this is what we are so 50 crore that we are having. So here it is 9 crore. Funding cost is how much? It is 9%. So 9 into 50, 4.5 crore. Now here we are having, so exposure is 50 crore. So expected loss is how much? So 0.07, that here we have put already. So here we have 7% is the probability default. Loss given default is 60%. So here we are having loss given default 60%, and exposure at default is 50. So total amount is nothing but 2.1 crore. So which means that operational cost is 1 crore that we are saying. So how much will be the portfolio profit? So portfolio profit will be 9 minus 4.5 minus 2.1 minus 1. So total it is going to be 1.4 crore. Considering all the scenarios. So for example, how are we calculating? So let me get back to this particular slide again. So here we are saying that in this case unit cost digital, so if you have the loan portfolio of number of loans 10,000 with the average loan size of 50, you are having the total exposure of 50 crore. Given these characteristics that you have calculated through alternative data or given the balance sheet exposures, if you have calculated these ratios, how much your interest income exceeds the funding cost that you are going to see. So it exceeds by 1.4 crore. It means that credit risk parameters strongly affect the probability. Better FinTech scoring reduces the probability default and expected loss, and lower operational cost also creates the scenario. So this is what we say. So at 9% you are lending to that person, the rest of the parameters you are seeing that it is less than 9. So 1.4 crore is your gain that you are having. So if you are going to see that using the same portfolio of exposure at default is 50 crore, loss given default is 60%, and if the default probability increases from 7 to 10%, then we can see expected loss at 7%, 2.1 crore. Expected loss at 10% 3 crore. So profit is going to decline further by 0.9 crore because 3 minus so 10% minus at 10% we are having 3 crore expected loss, and 7% we have 2.1, so it leads to 0.9 crore. So risk modeling, quality and monitoring accuracy are central to FinTech probability, which means that the risk modeling in terms of calculation of the PD and also the exposure of loss given default, all these things play a very important role. The another important angle that we touch upon is the FinTech and financial stability. So we have covered almost all the dimensions of the FinTech. Now we are sliding into a regulatory dimension, and I think the next 3 sessions are going to be on the regulatory part. So FinTech and financial stability like core trade-offs. So FinTech improves efficiency, competition, financial inclusion, but also introduces new risk channels, which means that the central trade-off that here we have. So here we have innovation, lower cost, then here we have the wider access, but at the same time it also leads to the 3 types of risk that we often discuss in the case of banking. One is the operational risk that we discussed in the last session when we were discussing the CAMELS analysis. Then here we had the liquidity risk and the market systemic risk. So all these angles play a really important role. The cyber and operational risk play another importance. Operational failures and cyber incidents create measurable economic losses. So expected cyber loss is nothing but here into the price into loss severity. So this is what here we have. So probability of major outage is the 2%. Loss severity because of the cyber and operational risk, suppose fraud, downtime, sometimes the services are not available because there is a downtime, and penalty, suppose it is 200 crore. So the expected loss is going to be 4 crore per year, and with these dimensions it becomes very important that the FinTech must be well equipped with the risk management tools like monitoring systems, incident response and cyber insurance. So regulator has to look into. Another aspect is that we have discussed already in the case of Diamond Divik bank run model, that liquidity and run risk in the FinTech linked model is also important. Suppose a wallet or neo bank like Entity has 5,000 crore, liquidity buffer has 600 crore, a confidence shock trigger withdrawal of 20%, then outflow is how much? Outflow is 1,000 crore. So this is what we expect. So liquidity gap is how much? Liquidity gap is having around 400 crore. So this is what here we have. Suppose there is a shock. For example, we saw that when Reliance had objections with when RBI had put a check on the Paytm, then it created a big impact. So if you have that kind of confidence shock, withdrawal of 20%. So 20% withdrawal will be like 1000 crore. And second thing is that unlike the banking system where we have the deployment of different capital, so CET1, then AT, then tier 2, here in case of fintech, that kind of the channels we are not seeing, which means that it becomes a burden on the regulator to provide immediate service. And this is where the liquidity gap that we are seeing 1000 minus 600, 400 crore, so which means that it requires safeguarding, it requires ring fencing, that we will be discussing the sandbox and other regulations that we are going to discuss later are linked with this, and this is where it plays a very, very important role. And if you want to see in terms of the value at risk, so for example, the value of the portfolio is rupees 300 crore, the daily volatility is 3% and confidence level is 99, so 2.33 Z value we are getting if you calculate. So the maximum amount of loss that bank and our fintech can incur is 21 crore, which means that there is a 1% probability that daily losses exceeds rupees 21 crore, and which means that it creates the significant tail risk, and it also having the capital buffers and exposure limits. So I hope with this background we have just started. Maybe I'll touch upon these angles again when we start the next session, but I hope this understanding has helped you drawing in a very systematic manner the channels of different types of regulations, and we have started learning it. So to just summarize what we have covered, so we covered in this particular session different types of data richness, that how it helps, the probability of default calculations, co-lending we calculated. We also saw that how much it has the benefit in terms of calculation expected loss, that how the fintech is going. We also looked at how fintech act as a competitor and how it supplements the banking sector. Competitor we saw with the NEFT example that 40 crore it used to earn, but because of the instant payment services by the fintech, the cost is almost zero, so banks are losing that money. Then we are also seeing that we checked into the regulation side that certain liquidity concerns or operational risk or the downtime or cyber security related problems may create further trouble for the fintech based solutions and services, and it requires further dimension. So keeping that in mind, I have designed the next 3 sessions on regulation. So with this, I am stopping it here. I hope you are liking the course and you are enjoying it, and we will have further discussion on this topic later. So with this, I am stopping it here. Thank you so much, and really appreciate your attention.